You think the ECB might actually stay its hand at this meeting?
Yeah, I think on the interest rates side, that's absolutely what we're expecting. The extension of quantitative easing is going to come. Whether it comes today or it comes another meeting, I don't think it really matters to investors. The idea that they would stop in March next year, I think, is preposterous given the inflation outlook, the slowing growth, the downgrade in forecast we're going to see. And what's even more worrying is the last 3 or 4 months is a slowdown in the fall in unemployment. Right? This has been a very important, impressive performance of the labour market the last couple of years. Stalled a little bit the last couple of months. I think that's making them nervous as well. So at the moment, probably stay their hand, but they're going to have so many questions about how do you find more bonds to buy? Because we just heard from Caroline that they have these restrictions. That's constraining what the university can buy.
There's a lovely line in the story this morning that talks about, obviously referring to Mark Carney's serenity, but Mario Draghi's going to be looking over his shoulder and looking at the berating that Draghi got. But the market's position itself, we've got here the yield curve. You go on, you've got the underused function, GC, on your Bloomberg, and what you've got here is the European sovereign, the German sovereign curve. This is 6 months ago. Right, this is 1 year ago, 6 months ago, and this is this week. These bull flatteners. Are you still, does that momentum continue in the bond market? And what does that do for your view in terms of corporate paper, as Caroline was referring to, the compression of spreads?
Absolutely. Yes, we're still overweight credit. We still prefer it more than either government bonds or equities as a place to get both total return and yield. I think within global government bond markets, you look at where Europe is right now, and it does make you a little bit nervous about some of those valuations. We saw the Bund shock and how quickly losses can mount. I think it was about 8% people lost total return in only 2 months during the Bund shock a little while back. So it does make me somewhat nervous. But look, you had that chart up there. I think there's definitely a leash effect going on here, right? They've got the deposit rate at minus 0.4. Everyone knows they can sell all their bonds at to the ECB at that yield, so you can work out what the price would be. Yep. And you see that curve coming down and flattening, more and more of the curve basically being pinned to minus 0.4. I'm sure it doesn't get to the point where the entire yield curve is flat at minus 0.4. Something's going to stop it from getting there, but that's the direction of travel. Yeah.
So in terms of the ECB's options, of course, other than a further rate cut and the extension of QE, changing the parameters, what do you think the best options are?
Well, I know that they don't want to change the capital key because that is pretty much like GDP in terms of what they want to buy. I would personally, if I wanted to ramp up borrowing, I'd still go over after more the corporate debt. I don't particularly want to buy bonds yielding less than the deposit floor. I'm not sure that they should cut the deposit rate any further than that. There's question marks over the efficacy of negative rates anyway. They are actually only going to own a small fraction of corporate bonds by March. There's plenty of scope to increase that, and of course you've got the big taboo, which also we might see the Japanese break from, which is buying bonds not in their own currency.
And that could be the movement. That takes us back round to the currency effect, because if they buy, let's say, US Treasuries, or for that matter, Aussie bonds, that's got an impact on currency. And this is where I want to get your opinion, because we've got the euro dollar here. Nero found this morning. Morgan Stanley basically saying no matter what happens, Draghi stimulus cannot stop a bull run on the euro. But if they did something drastic like overseas bonds, that might stymie it. Morgan Stanley said 5% rally to come on the euro. I mean, would you concur with that? Is the rise of the euro inexorable?
I'm not sure if it's inexorable. I think the policy can stop it if it wants to. But again, I think that's going to be breaking a taboo. For me, this is when the currency Cold War turns hot. Is if you actually start buying in different currencies. Look, other central banks have done it. The Chinese did it to a huge amount. The Swiss National Bank has enormous foreign currency assets. But Europe and Japan haven't gone there so far. But you can maybe smell the desperation, especially in Japan, with the strength of the yen, what that's doing to inflation, what that's doing to equity earnings, what that's doing to the momentum in the economy. I think all things have to be on the table. If there was a central bank that's going to break that taboo, a major central bank, I think it's the BOJ before the ECB.
What happens if Mario disappoints today?
Look, I'm not sure. I think the market's not priced for him to do much. So I don't think there's a big disappointment, risk out there. I think that he's going to face a pretty aggressive set of questioning about these options. He got a lot of those questions last time and basically said, "Look, we haven't discussed it." I'm not sure if that's credible, but they're going to question him a huge amount. I think we'll see the same rhetoric we've heard for the last few quarters. What we're doing is working. We need time. Unemployment's coming down, credit conditions are improving, interest rates coming down, borrowing's going up. Steady as she goes, we'll do whatever it takes.